Hello, good morning, good evening, good night.
Assalamu alaikum.
Alaikum salam.
How are you?
I'm fine. How are you?
Alhamdulillah.
How's the work?
What did you say? How is the
Work.
work?
Yeah,
Yeah, Alhamdulillah. All is fine.
good.
Okay. So, how was your day?
The good no, but also air closure and I have a lot of adjustment I was doing from the morning up to now. Just now I closed my laptop. I came to home.
Okay. So, your timings are from 9 to 6,
No, from the 8 to 4.
8 to 4.
Yeah,
Okay. Before Asar prayer, you come home.
yeah.
Okay, that's really good. You normally leave at 4 or you have to set after 4?
Sometimes because I head of the department, I sometimes sit up to 5:30, 6.
Okay. So, how many people you have under you?
Under me, 4 in the Khartoum and 3 in the, like 10 in the field.
Sorry?
4 in the Khartoum country office
Okay.
and 10 in the field, like 14 people.
14 people, mashallah. Okay. I have 7 people under me.
Good, sounds good.
Okay. So we have to start the CVP analysis today.
Yeah, that's good. I'm very happy today to start the real cost.
Inshallah. Okay. So
But I
starting,
have one question before the starting the CV decision making chapter.
sorry.
I have one question
Okay.
regarding CV analysis before the starting. Why you
Okay.
are in ACCA to study CBA? Yeah, to study decision making.
Why we are studying it?
Yeah, why are you studying this chapter?
Okay. Actually, this is the chapter in which we have to just measure, in this paper, we have to measure the performance of the company. Our objective is
That,
it. Okay.
yeah.
And the CVP analysis is the best measure to to control your cost, to check how much profit you are earning, real profit, and how much margin of safety you have. Okay. When a business start, obviously it is not profitable at the start. It gradually comes to profit. So CVP analysis tells us that how your volume, your cost and profit are interrelated. When your volume increases, your cost will also increase, and you should also try to increase your profit with this.
Okay.
So these three things are related, and every business performance depends on three things: cost, volume, and the profit.
What does the meaning volume in our volume?
Volume means how many units you are producing,
How many units?
the company is producing, the volume.
Okay,
How much
okay.
units they are selling. The volume means how much in quantity form you are doing it. Okay.
Yeah, now I got exactly. Now I got what you are saying. Can start.
Okay. And then when we start, we are first of all explaining the nature of the CVP analysis, and how, what is the break even point where you are achieving the break even, means no profit, no loss, and how much is the margin of safety when you go up from no profit, no loss position, how much you have margin of safety. Okay. Then we calculate contribution to sales ratio. We have calculated the contribution. Now we'll just look at the CS ratio. CS is the short form of contribution to sales ratio. Okay. In single and multi product situation, if a company has a single product or company has 2 or 3 or 4 products, then we have to calculate the target profit revenue in single and multi product situations, then interpret break even charts and profit volume charts. We'll just look at the graphs and interpret the information. From that, discuss the limitation of CVP analysis for planning and decision making. What is the limitation? Okay. Everything has its limitations except Allah and his plannings, because the man is preparing it. So there must be some limitations. Okay.
Yeah.
So we talk about break-even analysis. There's single product break-even, multi-product break-even, and the limitations. Break-even is the point at which you are earning no profit, no loss. Okay. Your cost is covered. Your cost is covered, but you're not earning a single penny of profit. Okay. That situation is called break-even. Clear?
Clear.
Okay. When we talk about single point break-even analysis, when we are talking, there is only single product. We have selling price, that is 200. We subtract variable cost, so we get contribution per unit, right?
Yeah.
And the total fixed cost is 6 lakh. Okay. So what it is saying, in order to break even, we need to cover our fixed cost. To get covered, we need to cover our fixed cost. Here the break even point. Hence, the break even point equals to total fixed cost divided by unit contribution. When we divide the total fixed cost divided by the contribution per unit, we get the break even point. Okay, that is 3750 units. Okay, 6 lakh divided by 160. If we check this answer, so what we'll do, we have to multiply. If you multiply 3750, let me open my calculator. We multiply 3750. Okay.
Contribution.
No, 3750 is our units at which we are doing break even. Okay. So we multiply this.
160.
160 is our, no, I'm checking my answer. So I am multiplying it by sales. Okay, my selling price is 200. Okay, I'm checking that I should earn 0 profit here. Okay, now my total sales revenue is 750,000. Okay, then we subtract the variable cost per unit from it. Okay, this is 750,000. You have to remember this. Okay, then 40 multiply by our units, that is 3750. This equals to 150,000.
Yeah.
Okay. What was our answer? 750,000.
75. 150.
150.
7050. 40.
Please repeat the numbers. I have just forgotten it.
7540.
7540 was our profit.
Yeah. Minus the variable cost given the 600. 600 minus 600 is 0.
I think we are doing something wrong here. No.
No. What you have to calculate 200 multiply into the 77.
One second. I'm repeating it. 3750 were break even units. Okay. 3750 multiply by 200. Okay. So we get 750,000. Okay.
Yeah.
750,000 is our sales revenue.
Yeah.
Okay. 750,000 is our sales revenue. Now we calculate the total variable cost. Okay. Total variable cost is 40 multiply by
370.
3750.
Yeah.
3750. So we get 150,000. Okay.
Yeah.
Now we subtract 750,000 minus
150.
150. 1, 2, 3. So we get 600,000. What was our fixed cost?
600.
600. 600 minus 600 means 0. Now our if we sell 3750 units, we will earn no profit, no loss. So hence it is proved that if we sell 3750 is our okay break-even point. Okay, this is correct.
Okay.
Clear?
Clear.
Okay. A further example, selling data related to product PQ. Selling price is 25, variable cost is 20, fixed cost is 50,000. Calculate the number of units that must be made and sold in order to break even.
10,000.
10,000. Okay. Then calculate the level of activity that is required to generate a profit of 40,000. Now we are thinking to generate up 50,000 profit. So how many units we have to produce to get the profit of 40,000? So our formula will change. Formula what is change? We have to add this required profit in the fixed cost.
Yeah.
Now the formula will change. Break even for this break even point, required profit plus fixed cost divided by contribution per unit. Okay, this is the formula, new formula, because we have to generate a profit of 40,000.
Okay.
Okay. Now required profit is 40,000 plus fixed cost. Fixed cost is 50. 40 plus 50 is 90. Okay. 90,000 divided by 5. Okay. So the answer would be, will give us a profit of 40,000. Clear?
Clear.
Okay.
Okay.
The company budget to sell 13,000 units of product PQ. Calculate the margin of safety. Now, the third thing is margin of safety. What is margin of safety? Budgeted level minus break-even level of activity. What is our budgeted level? Here it is telling the company budgets to sell 13,000 units of product PQ. Okay, 13,000 units. This is the budgeted sales. Okay. Okay. And the margin of safety, what does it mean? That how much safety we have?
3,000 is the above question.
13,000 minus that break-even point we calculated. Okay. 10,000. So 3,000 is the margin of safety. Do you know? Do you understand the concept of margin of safety? What does it mean now?
Means that if you are in the good place, if you have the product you have is greater than 1.
Yes. This means that you have this margin. If you have less margin, then you are at risk. If you have greater margin, it means you are able to cover your fixed cost. You are not going at a loss. Yeah. Okay. You're away from your break-even point. Yeah. Then we have to calculate the percentage for it, because this is margin. So we calculate in the percentage form. To calculate in the percentage forms, we'll do what? We'll just divide it by the budget sales. Budget sales minus break-even divided by budget sales again, because our base is budget sales. Then multiplied by 100. So we'll get the margin of safety percentage. This is clear? Clear. Confirm? Confirm. Okay. Then calculate the CS ratio. We talked about the CS ratio. CS ratio is what? Contribution divided by sales. This is the sales CS ratio. Okay. This is the shortcut of calculating the break-even point. If we have to calculate the break-even point in the form of dollars or sales revenue in the revenue form, then this formula will be used. Fixed cost divided by CS ratio. We'll get the break-even point not in units, it calculate in dollar form, units, sorry, revenue. Amount, yes, right, amount. Okay, fixed cost divided by CS ratio. How we calculate the CS ratio? Contribution divided by sales. Okay. And if we have to calculate the sales revenue that is required to generate a profit of 40,000, we'll just amend the formula now. Required profit plus fixed cost divided by the CS ratio. Okay. These formulas are very important. Okay. Now drawing a basic break-even chart. Here it is just, I'm just showing you the directly the graph. Okay. Here, this is the break-even point where you have no loss and no profit. This is a situation where the profit is achieving. Here is the situation, there is a loss. This point is called break-even. Okay. This is the number of units and this is your sales. When you increase your number of units, you get to this break-even point. Okay. And after that, if you produce further units than this, this is your margin of safety. This. Okay. Here you were, if you talk about this point, okay, here you were not able to cover your fixed costs. That's why you were in loss. Then you gradually covered your fixed cost, then went to the profit. Okay, this is the graph. Clear?
Clear.
Then you can just read this. It is not that much difficult and it is not that much important as well. The contribution break-even chart, there are different types of these charts. The profit volume chart, this is also a chart and you can just go through it. They are not so much hard or something like that. Okay. Then we have multi-product break-even analysis. Now the company is having more than one product. Okay. The basic break-even model can be used satisfactorily for a business operation with only one product. However, most companies sell a range of different products. Obviously, there are some companies there are very few companies who are only selling one product. You have many products. So CVP analysis assumes that if a range of products is sold, sales will be in accordance with the predetermined sales mix. Here in this, when we calculating the break even for the multi products, there is a assumption that there would be a predetermined sales mix. What is sales mix? It means that I would be selling A 2 units, B 3 units, and C 4 units. I will arrange a product mix and I will sell like this. Okay. Did you get it?
I got it, yeah.
Okay. This assumption can change as well. You know, this is only assumption. Okay. You can just also calculate that he can also, in question, he can also use this term that our A product sells 20%, B 30%. Okay. So this could be done. You have to know the product mix, sales mix. Okay. Then now we have to calculate the weighted average CS ratio. Okay. The weighted average CS ratio equals to total contribution divided by total revenue. In a multi-product situation, a weighted average CS ratio is calculated by using the formula weighted average CS ratio, total contribution divided by total revenue. Okay.
Okay.
Then weighted average CS ratio is useful in its own right, and it tells us what the percentage each dollar of the sales revenue contributes towards fixed cost. It's also invaluable in helping us to quickly calculate the break-even point in sales revenue. If you have to calculate break-even point, we will divide the fixed cost by the weighted average CS ratio. Okay. Now looking at this example, company A produces product X and Y. Two products it produces X and Y. Fixed overhead is 2 lakh per year. Following budget information is available. Sales price is 50-60. Variable is 30-45. Contribution 20-15. Budget sales 20 and 10. Okay. In order to calculate the break-even revenue for the next year using the budgeted sales mix, we need the weighted average CS ratio. What is the weighted average CS ratio? Total contribution
divided by total revenue.
Okay. So we have our weighted average CS ratio is 34%. Okay. And the break-even revenue is fixed cost divided by that percentage. Now the break-even is 581,819. Okay.
Okay.
Calculation in the illustration above provide only estimated information because they assume that product X and Y are sold in a constant mix. Here we assumed that X and Y will be sold in constant mix. 2 units of X, 2 units of Y. Okay. There is no mix of that X is sold more or Y is sold more. They are constant. Establishing a target profit for multiple products. When we talk about multiple products, our calculation will change fixed cost plus required profit divided by weighted average CS ratio.
Okay.
Okay. Now the formula is again changed. Just this required profit is included. Weighted average CS ratio is same. Fixed cost is same. Okay.
Okay.
Now, to achieve target profit of 3 lakh in company, 3 lakh, sorry, in company A, sales revenue required profit of 3 lakh, fixed cost plus required profit, weighted average CS ratio. So we have calculated 1454 for 545. Okay. If we earn a revenue of 14 lakh, then we will earn profit of 3 lakh. Okay.
Okay.
Margin of safety. We have two products, balls and rackets. Selling price is 8 and 4. Variable cost is 5 and 2.6. Contribution is 3 and 1.4. Here he has told us that More Limited produces and sells 2 types of sports equipment items. Balls and rackets. A batch of balls sells for $8, variable cost of 5, racket sell for 4 grand, and unit of variable cost 2.6. For every 2 batches of ball sold, 1 racket is sold. If we sell 2 balls, 1 racket is sold. The product mix is 2:1. Okay?
Okay.
You got this? 2:1.
2:1.
2 batch. If the
Two
2 balls are sold, 1 racket is sold.
Yeah, means that one and divide by 3 and 2 divide by 3.
1 divided by 3, 2 by... you can say that. Okay. But if we just say the ratio is 2:1.
Means that 50% half.
Yes. Yes. Okay. Then first we calculate the contribution per unit. That second step is calculate contribution per mix. If we have a mix, so what we'll do, 3 by 2 balls and 1.4 by 1 racket. So the contribution per mix is 7.4. Here we have to multiply it by the units sold per mix. So $3 $3 multiplied 2 and 1.4 by 1. So we have a contribution per mix of 7.4. Then other calculation is same. Fixed cost divided contribution per mix. Break-even point in terms of units of the products. If we just, then we'll also tell the break-even point in terms of both units. We have 55,000 mixes. Okay. So 55,000 mixes, to 1,10,000 balls will be sold and 55,000 rackets will be sold. So we'll get this break-even point. 8 multiply 1,10,000 balls, 4 multiply 55,000 rackets. So our revenue is $11 lakh. Are you getting this point?
Yeah.
If you want me to more explain, or it is clear here?
Clear.
Okay. Then margin of safety, budget sales minus the break-even sales. Here it is revenue 1.2 million divided by 1 minus 1.1 million. So 150,000 is our margin of safety. In percentage form, we have 12% of margin of safety. Okay.
Okay.
These are the graphs, you can go through them. Okay. Limitations. The assumptions of the break-even analysis, its limitations are its assumptions. The behavioral total cost total revenue has been reliably determined and is linear over the relevant range. We assume it, but it is not possible. All costs can be divided into fixed and variable. This is also not possible. Total fixed costs remain constant. Total variable costs are directly proportional to the volume. Selling price are to be unchanged. This is also not possible. Then efficiency, productivity are to be unchanged. Analysis either covers a single product. Revenue, perhaps the most basic assumption of the all volume is the only relevant factor affecting cost. This is not the case. We could other factors can also determine the cost. Only volume does not determine cost. This is its assumptions. The volume of the production equals the volume of sales, or changes in beginning and ending inventory levels are insignificant in amount. This is also an assumption. So these are the limitations of break even.
Okay.
Do you have any question here?
Good. I get it.
Okay. Now we can move further. Oof. Planning with limiting factors. We already discussed the constants, the theory of constant, where they are limiting factors which limits our production. Okay. Okay. Then firm face many constant. First is limited demand. Okay. I want to teach more students, but I don't have students. So demand is limited. Okay. This is the first constant. Then limited skilled labor are, limited finance. They don't have money. Planning with one limiting factor. Okay. The usual objective in question is to maximize profit. Given that fixed costs are unaffected or by the product decision in the short run, the approach should be to maximize the contribution earned. We have covered a similar approach in chapter 4 through throughput accounting. We already discussed. If there is one limiting factor, if there is only one limiting factor, then what steps will we having? First, we have to identify the scarce resource, the limiting factor, the constant. Okay. Second step is calculate the contribution per unit for each product. Okay.
Okay.
Then calculate the contribution per unit of the scarce resource for each product. Now we divide it by scarce resource and rank the products in order to contribution per unit of the scarce resource. How much contribution it is earning as per the scarce resource. Allocate resources using the ranking and answer the question. Now we look at the example. First, X Limited makes 3 products A, B, and C, for which unit cost, machine hours, and selling prices are available. Machine hours, it take 10 hours, 10, 12, 14. Direct material 50 cents per kg. Okay, 7, and it is used 14 kg. Then 12, 6 kg, 5, 10 kg. Okay. Direct wages 7.5 per hour, 9, 6, and 3. Variable overheads 333. Marginal cost is 19. Selling price is 25. So we have a contribution of 6, 5, and 4. Sales demand for this period is limited as follows. Product A can be sold only 4,000 units. Product B is 6,000. Product C is 6,000. Okay. Company policy is to produce a minimum of 1,000 units of product A. We have to make 1,000 units of product A, whatever the situation is. Okay.
Okay.
Supply of materials in the period is unlimited. Okay. But machine hours are limited to 2 lakh and direct labor hours to 5,000. Okay.
Okay.
Indicate the production level that should be adopted for the 3 products in order to maximize profitability. And state the maximum contribution. Okay.
Okay.
First step is to identify the scarce resource. What is the scarce resource here? First, we have to identify this. First, you identify this. I'm giving you 2-3 minutes. You try to identify the scarce resource, then we move forward. Okay.
Okay.
Try to just check it. I'm coming.
Hello.
G. Hello.
I'm taking up to see what's the question down.
Sorry.
And go up.
Go up. Achha.
No, down.
Down.
Wait. Here.
वालेकुम अस्सलाम। नहीं मिलाल भाई, कोई ऐसा इशू नहीं है। ये नंबर है, आप लतीफ़ साहब हैं, इनसे आप बात भी कर लें और मेल भी कर सकते हैं, इनको मेल भी कर दें आप, तो ये रिस्पॉन्स दे देंगे आपको।
Have you calculated?
No,
Hmm.
I don't know.
You can just guess the scarce resource from here. Okay, let's go to the answer. First, we are identifying the scarce resource. This may be done for you in examination question. Okay. At potential sales level, sales potential units are 4,000, 6,000, and 6,000. We did demand. Okay. Now, total machine hours required will multiply the, per unit machine hours, multiply these units. So we have 40, 72, and 84. Total machine hours, we are getting 196,000. And the total labor hours are 12,000. Okay. Okay. Then we go to our question again. What is the availability? It is saying the supply, the company policy is to produce, okay, the supply of materials is unlimited. Machine hours, we have 2 lakh machine hours. So machine hours are also very much we have. But the problem is direct labor hours are available only 5,000 and we need 12,000. Here we're seeing we need 12,000 and we need 196,000 of machine hours. So machine hours we need is under 2 lakh. So machine hours is not a scarce resource. Labor hours we need 12,000, but we have only 5,000. So labor hours are the limiting factor.
No, I didn't get it.
Okay. First, you know what is sales potential units. These are this is the demand.
Okay.
We go up again to the question. Now, the question again. We have demand of 4,000, 6,000, 6,000.